Hello, my name's Tom Beale and I'm delighted to be joined today by Howard Marks, the co-chairman of Oaktree Capital Management, who St James's Place has recently appointed to be the co-manager on our International Corporate Bond Fund. Howard, welcome.
Pleasure to be here.
Howard, perhaps we could start by talking about your views on the current market today. We've seen a slight pickup in markets since, certainly here in the UK, since the referendum, and it feels like there's conservative optimism. Would you say that is justified?
I think the outlook is very uncertain. Chances are there's a recovery going on. Chances are it will continue. I think the impact of Brexit is hard to specify. But on the other hand, with low interest rates induced by the central banks close to zero, it's likely that cash will continue to flow to high-yield bonds until it doesn't.
Yes, okay. And clearly a lot of the current situation in markets today has been fueled by the quantitative easing and the loose monetary policy which has been applied. How do you think that is having an impact on bond markets today, and as monetary policy becomes tighter, how likely is that bubble to burst?
Well, it's very complex. You know, we've never been through anything like this before. We've never had zero and negative interest rates before. I think that anybody who says they know how it's going to work out is wrong. So I think it's a good time to be cautious. And our mantra for the last 5 years has been move forward, but with caution.
Is that the same today?
It is the same today. We are investing, we are fully invested, we're happy being fully invested, but everything we do today has a substantial element of caution.
And one of the things many commentators talk about is the risks for bond investors when interest rates do rise, or indeed if interest rates rise. From your perspective, do you think it's possible to make money in a rising interest rate environment from bonds?
So I think it's inescapable that when interest rates rise, bond prices will decline. The questions are, number one, when? Number two, for how long? And number three, what does that mean? The latter question is the most important one. If you buy a bond today because it yields 6, and if the yield demanded of that bond goes to 8, it will fall in price. And as I said, I think that's largely inescapable. But if you're right about your credit selection, which is what we spend 100% of our time on, and that bond issuer turns out to be creditworthy and repays the bond and pays the interest as promised, you'll get your 6%. So you may buy here at a yield of 6. When the market says no, 8 is the right yield, it'll go down in price, but eventually it'll return to par at maturity, and you'll end up having earned the 6% you bought it for. So I don't think that's the worst thing in the world. Investors should learn to look through interim price fluctuations to the ultimate return.
And many people I've seen in the industry have said actually today people invest in equities for yield and bonds for return, which is the point you were making, I think, about potential dislocations in markets. Given your background of operating both equities and bonds, how do you think about the relative attraction of those two different assets today?
Well, I think that little ditty is kind of a clever sounding thing, but I think it's not right. Too many people overlook the existential difference between stocks and bonds. They're not just different asset classes, they are totally different in their essence. Bonds, as I said before, are a contract between the investor and the issuer, and the investor receives a contractual return which is fixed, that's why we call it fixed income, as long as the issuer turns out to be creditworthy. That's totally different from stocks. It's not slightly different, or it's not that the return is higher or lower. It's totally different in character from stocks. In stocks, there is no contract. Nobody promises the investor a return. The return essentially most of it comes from the market, depending on what mood the market is in that day. And all the investor is entitled to is a share of the residual which remains after the bondholders have been paid.
And one of the other trends we've seen in markets, or certainly in investing in the last few years, is that the rise of ETFs and an increase in client money going into passive funds. How much do you think that is distorting markets, and do you think this signals the demise of active management going forward?
Well, the passive investment, by definition, does not make judgments. The question is whether investment results can be improved through the manager making judgments. Here's a very simple math. Historically, since 1978, when I began, on average, 4% of all high yield bonds have defaulted every year. Our default rate over the last 30 years is closer to 1%. So we have been able to weed out the majority of the bonds that default. That's the return for active management when it works. And if we can continue to avoid a good portion of the defaulting bonds, then there will be a reward and we will outperform the passive. In an ETF, nobody's making credit judgments. Nobody's saying, I'm going to buy this bond because I think it'll pay and exclude that one because I think it won't pay. They're just buying a broad swath of bonds. And the question is whether a skilled manager can add to the experience by making credit judgments, and I think the answer is yes. I worry about ETFs. An ETF is an exchange-traded fund, and perhaps you have a high-yield bond ETF, and the implication is that you can sell it any day. In other words, that the ETF is more liquid than the bonds themselves. How can that be? If it were more liquid than the underlying, where would that increment of liquidity come from? Is it mechanical? Is it supplied by a person? Well, I think the answer is no. And so in good times when all is sanguine, ETFs are liquid. They have really yet to be tested. And I think that they have the potential to disappoint. People shouldn't think that they know how things are going to work, which have never been tested. And, I'm not saying categorically that there will be a problem. I'm only saying that ETFs are largely untested in a negative environment. So I'm leery of any investment vehicle which claims to be more liquid than the underlying asset.
Thank you. And just a final question. If you were to give our investors one piece of advice when they're looking at all the noise in the media and different assets which they have choice from, what one piece of advice would you give them to think about the best long-term investment strategy?
Well, I think the key is to avoid or ignore what you call noise. And you have to distinguish the realities from the rest. The realities are that high-yield bonds are contractual instruments where you will get the return you bought for if the manager was right in making the credit judgment. We've been making credit judgments for 38 years. It's the only thing we think about. We don't try to guess the direction of the market. We don't try to manipulate cash, go in, go out. We don't try to figure out which companies will be upgraded or taken over. All we do is try to weed out the companies that don't keep their promise. And we've been pretty good at it.
That sounds like great advice. And Howard Marks, thank you very much for your time today.
Pleasure, Tom.
Thank you.